Have you ever thought to yourself, why am I paying all this income tax when I am working so hard for my money? Well, you aren't the only one with this mind-boggling question going through your head. For as long as we can remember, the United States and most countries around the world have had a law of tax for almost all of its citizens, with the exception of the 1%. This law is put into place to help pay for things that we as citizens of that country use or need, such as police, schools, healthcare, building roads, social security, government spending, defense structuring, and the list goes on and on. To be able to pay for all of this, countries tax their citizens. We are being taxed on the products we purchase, anything from groceries to that brand new or used car you just bought. And of course, we are all being taxed on our income. Yes, that one tax we all cannot seem to stop complaining about. The one that pricks your heart every time you get a paycheck and look at the number of dollars deducted from your hard-earned money for that week. Money that you had to put in a lot of seemingly endless hours, energy, and sweat to get. It seems like Uncle Sam has been doing too much taking and probably not enough giving. Well, I guess that's how it always has been and how it always will be. And there's nothing you or I can do to change this annoying part of our financial life that we despise so much. Or is there? Ladies and gentlemen, today I'm going to show you how you can take income taxes out of your life if you choose to do so, and say goodbye to those painstaking, heart-wrenching deductions you see taken out of your hard-earned money. Believe it or not, there are overly developed countries when visited may seem to have a high rate of income taxes. You might think this because these countries are unbelievably modernized with such sound economic, financial, and social infrastructure. Not to mention an extremely low crime rate. Well, actually, the countries I'm about to talk about impose little to no income tax on their residents. Let's look at our first income tax-free destination and take an in-depth look at how much the citizens of these countries are paying in taxes. I'd like to point out to the viewers that there are other countries that do not impose income tax on their residents that were not included here. However, for the sake of the length of this documentary, I went ahead and condensed that list down to the ones I believe have the highest quality of life and lowest crime rate in the world. The luxurious city of Dubai, located in the United Arab Emirates. This city, which appears to have emerged from the sands of its desert, which is home to the tallest building in the world, was established on December 2nd, 1971. It has an estimated population of 9.8 million, an annual GDP of 431 billion US dollars, according to the IMF. Dubai also has a per capita GDP income of about 74,000 US dollars, ranking it number 7 in the world for per capita GDP on a purchasing power parity, or PPP. The United Arab Emirates also happens to be the second safest country in the world in terms of crime and natural disasters. It must be a relief to live there, right? Well, that's not the best part. In the United Arab Emirates, the employees who command the highest salary, right behind the locals, are American, British, Canadian, and Australian citizens. He would also have more purchasing power in Dubai than he would have in the US or the UK. In fact, with enough experience, that branch manager, if offered a job, could even potentially negotiate for his or her housing, private schooling for children, and transportation expenses to also be covered by their employer, giving that employee an even higher annual salary. A salary that is in no way comparable to what an employee would make if he or she lived in the United States, the UK, or Canada for that matter. Let me compare a few more salaries just to see what a person would potentially make by moving to a city like Dubai. A teacher could make anywhere from 4 to 11,000 US dollars a month. Teachers in applied or private institutes are paid the highest, of course. An airport customs or inspection officer could make anywhere from 4 to 9,000 US dollars a month. A bank branch manager or private banker could potentially make 7 to 16,000 US dollars a month. An airline captain, he or she could make anywhere from 14 to 22,000 US dollars a month, and ladies and gentlemen, that is all tax-free. Now, if you have enough experience and a bachelor's degree or higher, you can most definitely negotiate a few of those points mentioned earlier on top of your annual salary in any of these professions. And don't forget, at the end of the year, that income is tax-free. Now, you might be asking yourself, with all this talk of no taxes, how can a city like Dubai possibly sustain such a strong and stable economic and financial infrastructure that has only grown in the past decade without imposing upon its citizens any taxes? Well, to be clear here, it has implemented a new sales tax of 5% on all goods purchased not too long ago. But that can't be enough to sustain a country with a population of over 8 million, can it? Especially since they only implemented this VAT tax not so long ago. The truth is that Dubai has its many sources of revenue, such as tourism, a tax-free trade zone. Dubai is considered to be both a modern-era tourist and a business hub. As mentioned, Dubai is home to the world's most busy and largest free economic zones, known as Jebel Ali Port and Free Zone, or more simply known as JAFZA. A free economic zone is a term referred to regions that tax companies lightly or not at all. JAFZA was established in 1985. As of recently, it is reported that this free economic zone brings in an annual revenue of over 88 billion US dollars, making up almost 32% of Dubai's GDP and 10% of the entire country's GDP. This mega free trade zone is home to over 7,000 global companies, 100 of which are from the Fortune 500 list. Jebel Ali Free Zone is responsible for 32% of the foreign direct cash flow into the United Arab Emirates. JAFZA provides stable employment to over 145,000 employees, making it a cornerstone of Dubai's economy. However, it wasn't always sunny and rosy for the UAE back in the day, when they were first trying to gain independence from Britain, which they eventually achieved in 1971. It just happens that the United Arab Emirates back in 1971 was struggling to compete with the revenue of its neighboring city, Abu Dhabi, was taking in from all that black gold. So naturally, they did what any city with oil resources looking to better their economy would do. They sold much of their oil reserves in the 1970s and spent the next 2 decades after that investing almost all of its oil revenue back into Dubai to build a more robust, more stable infrastructure, turning it into the thriving and breathtaking city it is today. This investment, made during the period between the 1970s and 1990s, turned Dubai into a leading tourist destination, making it the 4th most visited city globally, with an astounding 16 million tourists visiting per year. The United Arab Emirates has emulated a similar strategy to that of Singapore by heavily investing in its newly founded fortune in extensive trade ports, airports, education, and anti-government corruption, turning it into one of the world's most luxurious and most visited tourist hubs, containing the largest trade-free zone in the world. But enough on Dubai for now. We can get into more detail on this vibrant city and the United Arab Emirates as a whole in another video. Let's take a look at what other parts of the world offer a similar tax-free incentive for working there. Next on our list of income tax-free countries is Singapore. This island, which happens to be surrounded by 63 smaller islands, is a radiant and beautiful metropolis. It is home to one of the most luxurious airports of the world, which has a mind-boggling 2,000 trees and palms inside of it. This island also has the second highest observation wheel anywhere, and of course, my favorite advantage to living in Singapore, it has one of the lowest taxes on income for employees in the Southeast Asia. Don't believe me? Just ask Eduardo Saverin, the co-founder of Facebook, who back in September of 2011 gave up his US citizenship and moved to Singapore. Although he does claim the only reason he did this was to move and work in Singapore and not to avoid the potential $700 million in capital gains taxes he would have owed the US government. Can't blame him there, can we? Singapore has a population similar to that of the United Arab Emirates, totaling almost 6 million people as of 2020. Singapore's annual nominal GDP is a staggering $391 billion, ranking it 34th in the world, and a nominal per capita income of around 66,000 US dollars. It also has a GDP of $101,000 on a PPP basis, placing it at number 8 on the list of the world's highest GDP per capita on a PPP basis. Singapore's population enjoys low unemployment and robust activity across several sectors, including consumer electronics, information technology, medical and optical devices, pharmaceuticals, transportation, and of course, financial services. Singapore's success can be attributed to former Prime Minister Lee Kuan's foresight and wisdom. His strong financial and economic policies ensured a corruption-free environment in the government. He also limited the operation of foreign banks and instead encouraged the development in the technological sector. Aside from this, the economic and housing development boards provided opportunities for the locals to grow out of poverty and upgrade their living conditions. All these are the same factors that make Singapore still one of the world's wealthiest countries today. Singapore offers multinational companies a transparent and friendly business environment, a strong free market economy, in addition to a low corporate tax rate of 17%. Singapore's high standard of living and its position as a gateway to the rest of Asia enable this small nation to offer significant benefits to both companies and individuals alike. Singapore Singapore follows a progressive tax rate starting at 0% for the very low end of income earners and ending at 22% for individuals making more than 230,000 US dollars annually. And believe it or not, there is no capital gains or inheritance tax. Unlike the United States, where residents are required to pay taxes no matter where they earn it, in Singapore, citizens and residents are taxed only on the income earned in Singapore. So let's say your net income after deducting all expenses is 65,000 US dollars. Your tax rate in Singapore would be less than 3.5% as an expat living there. If your net income is 35,000 after applying all allowable deductions, then your tax rate would be less than 2.5%, which isn't much at all given that you can make over $120,000 and have most of it deducted and reduced to a net income of a mere $35,000 annually. Of course, that is if you have a smart CPA who knows what they're doing. Now keep in mind that unlike the United Arab Emirates, Singapore has what is called a tax treaty with the United States, meaning whatever you pay in taxes in Singapore can be deducted from your tax rate in the United States for your earned income overseas, making Singapore an even more tempting tax haven. I will get more into earned income limits for US citizens and UK citizens living overseas later on in this video, so be sure to watch to the very end. Singapore also happens to be the least corrupt country in Asia and the 5th least corrupt country in the world. In addition to this, Singapore's low tax rate and high pay have afforded its citizens the highest percentage of home ownership in the world at a whopping 92%. As for the ones that rent, well, Singapore has made it extremely easy on them by allowing government housing at which 80% of renters, including expats, live in, allowing for affordable rent rates compared to non-government housing units. So if you ever think of moving to a tax-free haven in Asia, you most definitely want to have Singapore at the top of your list. This next tax haven for both low and high income earners brings us back to the Middle East, to one of Dubai's neighboring countries. I present to you Qatar. Qatar is actually on the top of the index list of safest countries in the world. It has a world risk index of 0.31, making it the safest country in the world in terms of crime and natural disasters for 2020. Qatar is among the top 10 leading producers of LNG, also known as liquefied natural gas. Due to the revenue generated from natural gas and oil, Qatari residents are the highest earners in the world. The IMF estimates Qatar to be number 1 in terms of GDP on a PPP basis for the year 2020, giving it an estimate of 138,900 US dollars per capita. Qatar also happens to have the 9th largest airport in the world and can handle a capacity of 50 million visitors per year. It also will be hosting the next FIFA World Cup in 2022. Qatar is investing over 260 billion US dollars in infrastructure to be able to host the FIFA World Cup in 2022. This small country surrounded by sea has a population of 2.9 million. Now let us get into the tax details and why this country is on the top of my list. The state of Qatar has what's known as an excise tax of 100%, which is a tax on tobacco, energy drinks, carbonated drinks, and alcoholic drinks. I think a lot of us won't really blame them when it comes to taxing these products because they can cause substantial damage to a person's health, and they try to discourage consumers from consuming these products by placing a high tax on them. Now, unlike its neighboring country, the United Arab Emirates, Qatar has not implemented a 5% tax on goods and services, and I believe the reason behind this is so not to discourage expats and investors from moving there. Qatar has an amazing and attractive 0% tax rate across the board on property, transfer, inheritance, and of course, our favorite, payroll taxes. Remember earlier when I told you I would get into the details of tax rates and income limits on money earned overseas? Here is a brief breakdown of what you can expect to pay in income taxes to your home country of citizenship if you were to move to any of the countries mentioned in this video. So for example, let's say you're a US citizen and are a permanent resident of Qatar or the United Arab Emirates, or even Singapore for that matter. You can expect to only pay income taxes if you make a net income over $107,600 annually. This is because of what the IRS calls Foreign Earned Income Exclusion, or FEIE, and the $107,600 is the limit that has been set for the year 2020, and this number will continue to go up to allow for adjustments to inflation in the future. Now, if this earned income limit of $107,000 isn't sweet enough, keep in mind that the United States Internal Revenue Service has something called Foreign Housing Exclusion, which allows US citizens to take additional deductions off of their earned income, potentially giving them more leeway in their taxed income as long as they can prove their residency abroad. So let's do a quick hypothetical. Let's say you were to earn $125,000 in 2021. Now you are allowed deductions as you would be in the United States. Your accountant would apply all the various deductions allowable, such as daycare, schooling, depreciation of assets, expenses, and the list goes on. All of this, of course, is dependent on the circumstances of your household. Now, for the sake of our example, say your accountant, after taking in and deducting all expenses, arrives at a figure of $85,000 for that year. Now, in addition to the deductions that were just mentioned, you can now go ahead and deduct even more expenses. These are your expenses abroad. Like I said, the IRS allows a federal housing deduction. You can take whatever is remaining. In our example, it was $85,000 US, which would technically be your net income if you were living in the United States. Now, what you would do, or your accountant would do, is deduct your housing expenses abroad for that tax year. So let's say you are renting a charming 3-bedroom apartment in the Pearl area of Qatar and you are paying $36,000 annually for it. So what you would do is take $36,000 and deduct it from your remaining net income of $85,000, which would give you an even lower overseas earned income of $49,000 US, which is way below the allowable earned income limit, which would in turn make you, my amazing viewers, and potential future expats income tax free for that year. Now, if you are a citizen of the United Kingdom, well, then you're in luck. You see, the United Kingdom has a much more relaxed tax system for its citizens residing overseas. If you thought that Americans had it good, wait until you hear the tax limits on foreign earned income for the UK. The United Kingdom tax laws state that if you are a citizen of the United Kingdom, but you are not a resident of the UK, then you do not pay any income tax, payroll tax, or any tax for that matter on foreign earned income. So you're thinking, what constitutes whether I'm a resident of the UK or not while working and living abroad? Well, it's quite simple, and surprising that the UK has made their tax laws this simple for citizens who live and work overseas. UK tax laws state that if one of the following falls under your current situation, then you are considered a non-resident. The first scenario in which you are considered a non-resident is you spent fewer than 16 days in the UK, or a total of 46 days if you have not been classified as a UK resident for the 3 previous tax years. So in other words, if you have not been classified as a resident for the 3 previous tax years and you stayed less than a total of 46 days for any given tax year, then you are considered a non-resident. The second is you work abroad full-time, averaging at least 35 hours a week, and spent fewer than 91 days in the UK for the tax year in question, of which no more than 30 days were spent working. So basically, if one of the 2 mentioned scenarios applies to you, then you are automatically classified as a non-resident and you will not be paying an income tax from earned income for that tax year for as long as you are a resident of that overseas country. Now, I should mention this tax law does not take into account money earned from capital gains or inheritance tax. That is a different category on its own with a slightly different set of rules put into place. You should definitely seek a certified CPA's advice before considering a move or accepting a job abroad. But with that aside, it is really nice to have such simple, relaxed tax laws in the UK. Let's not get too happy just yet. So we just mentioned how you can be considered as a non-resident of the UK. Now let us talk about how you would be considered a resident of the UK. Let us get into the bits and pieces really quickly here. So as we said before, you are either classified as a non-resident or resident of the UK while living abroad, and this determines whether or not you would have to pay an income tax on your earned income. Now, to be classified as a resident of the UK, the following would have to pertain to your current situation. Before we get into more detail on residency status, let me mention that the UK tax year is from April 6th to April 5th of the following year. So if the days you spend and count while in the UK for residency and tax reasons, those days will be calculated between the time frame of April 6th and April 5th the following year, and that is considered a full tax year in the United Kingdom. Now back to what I was explaining. So to be considered a resident of the UK, the following would have to apply to you. You either spent 183 or more days in the UK in that particular tax year, or your only home was in the UK and you have owned, rented, or lived in it for at least 91 days in total, and you spent at least 30 days there in that particular tax year. If you've done either of these, then you are considered a resident of the United Kingdom and will have to pay taxes on your earned income overseas for that tax year. So in the unfortunate case that one of the mentioned applies to you while working abroad during that particular tax year, then your income tax rate would follow that of a UK tax resident. Another vital piece of information for you to know: if you were to move to one of the countries mentioned earlier at, say, September, you will most likely be considered a half-year resident of the UK and would need to pay taxes on the income earned while in the UK for those months before moving. And if you happen to own real estate in the UK while working abroad, then the rental income derived from that property will most likely have taxes imposed on it, depending on what is left in income after deductions are applied. Now, when you are coming back or moving back into the UK, let us say that after 5 years working abroad in any of the countries mentioned earlier in this video, you suddenly got homesick and were thinking of moving back to the UK and becoming a resident again. Then in that case, any income you saved up overseas and brought back with you into the United Kingdom can potentially be subject to income tax. It can be even more complex than this, especially if you draw an income from multiple locations or countries or travel around a lot after moving overseas. Although it may seem that I have gone into extensive detail on this matter, I strongly recommend you make sure you get professional advice from your accountant or a certified CPA so you don't fall foul of the law.
Harry!
Yeah, one more thing. None of them want to pay taxes again. Ever.
So, my amazing viewers, it's been great sitting here and discussing this intriguing roadmap which might lead you to a better financial life. This is why I created The Financialist, a channel that can help us better our lives financially, and I hope it really does that. I plan on bringing you more essential documentary style videos on finance, business, and anything related to making money or saving money, hopefully adding insight into how we can better ourselves financially. And if you enjoyed today's video or gained any useful insight from it, please like, subscribe with your notifications turned on, and you would be surprised how much it helps support this channel and in turn helps me bring you more content like this. If you know a friend or relative that might benefit from the knowledge passed to you in this video, then please do me a favor and share it with them. What are your thoughts on moving to any of the countries listed here to save and pocket that extra money from not paying any income taxes? Is it worth it? Let me know in the comments below and I will surely respond to any questions that you might have. Thank you all, and I wish you true financial success.